accurate, but I'd say more accurately, we're investing directly in people. So this is fairly unique. I'll kind of go into our mechanism, but it's definitely not something that you've probably ever seen before. So my name is Will Stringer. My company is Chisos Capital. Like Marty said, kind of born and raised in Texas. Actually went here to UT Austin and started my career out in Houston before kind of swimming against the grain and going out to California to really get into the early stage startup world. And so Chisos Capital, like I said, is investing directly in people. It's kind of a blend of a quasi credit instrument and equity in a large portfolio of early stage businesses. And so what we like to say is that we truly unlock talent by providing day one capital to individuals that are starting some type of endeavor. So for our fund 2, which we're currently raising, we're investing in entrepreneurs. But as we grow our platform of investing in people, we see makers and creators as potential individuals that we invest in. We see athletes, amateur athletes, as individuals that we'd invest in. So this presentation, we focused on the entrepreneurs and how we're investing in day one entrepreneurs. But it's a broader platform for really investing directly in individuals. So what we found was that a new capital solution really was needed for the extremely early stage. So when someone goes to start a business, typically that first capital, $20,000, $30,000, $40,000, comes out of the founder's own personal savings, or friends and family, kind of their network. And what we found was that is oftentimes not available. Maybe an individual can put in $10,000 to $20,000. Maybe they can scrap together another $5,000 to $10,000 from friends and family. But if it's a software company or an app, oftentimes even just to get the minimum viable product out or developed, you need $50,000 to $100,000. And so there's really that gap in the beginning that's a bit of a chicken and the egg problem. So you need the capital to get the minimum viable product to start gaining some traction, to then go raise angel or venture capital. But you can't get that capital in the door unless you have the traction. So bit of a chicken and the egg problem. And that's where we're coming in. That's where we said, okay, how can we get capital into the hands of these entrepreneurs day one to really help get them off the ground? And what we came up with was using their future earning potential, the individual's future earning potential, as collateral, essentially. And so investors often want to put a strategy in a bucket, and like Marty was saying, and like this is titled, it looks like venture debt for the very earliest stage. It feels like revenue-based financing for individuals, but what we're calling it and what it is a convertible income share agreement. So it is different than other instruments that are out there. And it is truly a blend of quasi-debt credit instrument and equity. On one end, you have traditional angel investments that you make in early stage companies. On another end, you could say you make loans or provide credit to individuals. And what we're doing is blending the two. So our instrument really has both pieces, and there's two ways to make that return. One is through the quasi credit instrument, which provides cash flow, which provides downside protection. But then, especially with entrepreneurs, we own equity in the company. So if they build a very successful company or even mildly successful company, we'll be an equity holder and have some type of liquidity event on the equity side. So how are we doing this? Like I said, it's two separate instruments that interact. We make one investment. Our average investment size is $40,000, and we get an income share agreement that is signed directly with the individual. And then they issue us a safe or simple agreement for future equity in their company. So we hold both of those instruments. The income share agreement basically says you as an individual, when you earn income over a certain threshold, in our case, it's $40,000 annually, you're going to pay us a fixed percentage of your income until you hit a repayment cap or a time cap. So for our standard terms, that's 10% of your gross personal income. And I like to make the distinction that this is not revenue in the business. So the business could be doing $1 million in revenue, and the payments required on the income share agreement would not be affected by that business revenue. What drives the payments on the income share agreement are the individual's personal income, 1099, K1, W-2 income. So that's an important distinction. An example that we give is, day one, Jeff Bezos raises a little bit of outside capital to start his e-commerce company. If we had been there to make that $50,000 investment, we basically would have said, okay, we believe Jeff will have future success no matter what. Even if this business fails, he was a hedge fund VP. We think he's going to succeed. So we're going to invest in him personally. He would have signed the income share agreement with us, and then we would have had equity in his e-commerce company. Now, two possible outcomes occur. One, success case. We're an equity holder, great upside success as an equity holder, and we get paid off through Jeff's future income. So two ways to make money. But the unique feature on the downside is Amazon fails, e-commerce fails, say, very quickly. Jeff, what does he do? Maybe he starts another company, maybe he goes back into the hedge fund world. He's going to earn personal income somehow. He's going to be successful. And we're going to get paid back on a monthly basis over time from his personal income. So for us, great downside protection, betting on these high potential individuals, but also an uncapped upside potential as an equity holder in their company. Now, because we're investing in very early stage entrepreneurs, often we bring more than capital. So we're bringing very early stage resources, perks, a database of mentors, advisors, service providers, upstream investors. Basically, we're trying to surround these individuals with as many resources as we can so that they succeed. And oftentimes we'll hold office hours or kind of bring in guest speakers to talk about things like fundraising, using outsourced development, early stage marketing, core tenets of building an early stage business. We, like I said, really want to surround them with resources and support because the higher chance of success for the business gives us a higher chance of actually seeing some type of return on the equity versus just the income share agreement. And I will say, if there are questions, I think you can probably put them in the chat, and happy to have kind of a dialogue instead of just continuing the monologue. So I think I mentioned earlier, my background started in banking, went over and actually worked at a single family office out of Houston on the investment team. And that time there really informed how we designed this instrument. So we designed it both for investors and founders in a way that allows capital to come in at that early stage. Typically you think, okay, day one, early stage company, super risky, not really a place I'm going to make the investment unless they're showing some type of traction. Well, that's why we structured our convertible income share agreement the way we have, so that capital can come in day one and have a good risk adjusted return or risk reward ratio. And so for investors, you have that uncapped equity upside. You have quarterly cash yield, so cash flow coming in every single month. And for fund two, it's paid out on a quarterly basis. And then you have a differentiated view of early stage companies. So typically, these are not the standard companies that every VC, every angel in New York, Silicon Valley are seeing and investing in. A lot of these companies are middle America. Some of these companies have founders that don't come from Stanford or Google or some of the Ivy League schools. So it is a differentiated set of companies. And as we're investing day one, likely many of these companies will raise additional rounds of capital. And so there'll be co-invest opportunities as we have pro rata rights on every investment. And then for the founder, why would they take our money? Again, it's pre-traction capital where there really aren't other options. So founder goes to start a company, they can max out their credit card. Maybe they have some friends and family capital. Maybe they take out a home equity loan, but there's really no good option at that stage. And that's where we can come in, be one of those first checks and support that founder with our flexible investment terms. The three types of founders and companies that we're seeing that are really interested in our types of funding. One, founders that are not on the coast, not in California, not in New York, and less well connected. So they don't necessarily know how the game is played. They don't know who to raise from. They don't know how to structure their pitch to go raise money. And so they find us. We have an open online application. We're underwriting them as an individual and then doing high level diligence on their company. We can be that first check-in and then help train them up so that they can learn how to play the game, learn how to structure their pitch, introduce them to upstream investors, and then they can eventually go raise that next round of angel or VC capital. The second bucket we're seeing is called sub-venture scale businesses. So maybe it's a niche software business that's playing in $100 million total addressable market. Obviously, that is not fundable by venture capital. Likely not going to be a unicorn, but it could be a $20, $30, $50 million business. That's a good business, especially for us. And the type of capital that's available for that company is also fairly non-existent. And so we can come in, make that investment, help them grow, maybe bootstrap the company, reach profitability, and then hopefully down the line sell for 20 or 30 million. And that's a great exit for us. We'll have our return through the income share agreement with that founder, but then we'll also be an equity holder in their business for some kind of liquidity event. And then lastly, we've been used as a type of bridge. So a few venture scale type companies will come to us and say, hey, this $50,000 can extend my runway for 5 or 6 months, 4 or 5, 6 months, something like that. My growth is extremely high. And so that 4 or 5, 6 months allows me to vastly improve my numbers and metrics and then raise at a much higher valuation in 5 or 6 months. And so we've actually had our capital used in that situation a few times now. The unit economics on each one of these investments, again, pretty attractive risk profile. So the absolute downside case, aside from a individual running off to Costa Rica and never hearing from them again, the absolute downside is company fails day 2 after we make the investment, and we get payback over time through that individual's personal income. That can be, depending on how quickly they pay us back and a number of other factors, 1 or 2x over, call it 4 to 7 years. Those income share agreements alone are about a 12 to 15% returning instrument, not even inclusive of the equity. Then obviously on the upside, any kind of equity has a large outcome. We're coming in at fairly attractive valuations, somewhere in the range of 1 to 5 million pre-money, really depending on how far along the company is. And so there is a $50 million company that suffers little dilution. That's a great outcome for us. And we've done this. So we have 24 investments that we've made so far. We raised a small fund 1 early in 2021, made 12 investments out of that fund. We held a first close on fund 2 a couple months ago and have completed 9 deals out of that fund. And so it's working. Long story short, it's working. We have cash flow coming in from income share agreement payments. We have, at this point, I believe 5 equity markups, meaning we made the investment and then at a later stage, another investor came in and put money into the company. And so exactly like we designed it, it is working. For fund 1 investors, we closed on that fund in February of 2021. We sent back our first distribution in July of 2021. That was 5%. We just sent back a 4% distribution in January of this year. And so for Fund 1, every 6 months, we'll be sending back capital. For Fund 2, we're targeting a quarterly distribution for all available capital that comes in from income share agreements. Where do we find these companies? That's always a question we get asked. So there's really two main buckets of sourcing that we use. One is very traditional marketing. So we're on podcasts, we're putting out blog posts, we're on social media, posting in forums, really just trying to get the word out about Chisos, what we do, and who we're right for. Because the lack of capital at this day one space is so prevalent, when people come across us and they are starting a business, they're always looking to learn more. Oftentimes they'll just go straight on our website and fill out their profile. And then that kind of kicks off our underwriting and diligence process. The second sourcing bucket that's really provided some of the best opportunities is strategic partnerships. So we're talking with as many accelerators, incubators, and other VCs as we can across the United States to tell them, hey, we're Chisos, this is what we do. You're going to see a ton of early stage deal flow that's either too early for you or not a right fit. Send them over to us. We'll underwrite them. We may be able to make an investment and then potentially level them up and send them back to you for a later stage investment. So we've gotten a lot of referrals through those partnerships. And honestly, the accelerators really enjoy it because oftentimes some of the accelerators and incubators don't write checks. And so we can partner with them. We can be some of that first capital in. They can provide some really strategic resources and education programs. And it's a great partnership for both of us because the founder gets both educational resources and a structured program to learn. And they also get $40,000, $50,000 to pay some of those early expenses. When we're underwriting investments, we're looking at three main buckets of information. So for every opportunity, we're looking at the individual for two buckets. One, we are looking at their financial picture, personal financial picture. So credit score, income levels, debt to income ratios, making sure that they're in an okay financial position. Second, we're looking at psychographic type information. So grit, hustle, ambition, leadership, some of the traits that data shows makes a higher chance of success for an entrepreneur. So we are trying to understand those traits of the individual. And then lastly, we're looking at the business. So we're doing high level venture diligence to make sure that they have a feasible go-to-market strategy. They understand their customer. They have incorporated the business, some very basic things to just say, hey, this company has a chance to succeed. There's pretty good data out there that shows that at the very earliest stages, there's really no good predictor on what companies will ultimately succeed. And so we try and say, all right, this company is viable. We think there's a decent chance that this succeeds because maybe the entrepreneur knows the industry. And that's the diligence we do on the business. So we combine all three of those buckets, and we have a proprietary scoring algorithm that helps us stack rank each of our opportunities to then invest in the top opportunities that come across our desk. In terms of the types of companies, so we are industry agnostic, but we are looking for capital efficient and scalable companies, fairly generic terms. But since we're making a relatively small investment, we want the company to be capital efficient. We want our check to move the needle, get them from 0 to 1, help them start putting some money into growth marketing, or maybe finish up development of a minimum viable product. And so oftentimes it's easier to say what we don't invest in, which is capital intensive type businesses, pharmaceuticals, things that are going to take a lot of money and a lot of time to actually reach some type of traction. And then on the scalable side of things, not looking to invest in single location brick and mortar or a one-off food truck. We do want to see some type of scalability for the company. And so often that leads us to look at software apps, gaming media, e-commerce, food and beverage, again, scalable and capital efficient type business.
We got about 5 minutes.
Okay, perfect. For our team, so I mentioned my background, finance, banking, family office background. Also spent a year as a product manager at a fintech company where I met my co-founder. My co-founder's background is more technology and software, so hardware and software. And it's really a perfect combination given that we've designed unique investment terms, but we're also heavily leveraging a technology platform to allow us to source, underwrite, and service these investments at scale. So like I mentioned, we have an open online application. We have a profile where a founder fills out a whole host of information. That information comes to us. It's then automatically kind of pre-qualified based on a few different factors. Then goes to a little bit of manual review to take a look at the business, and then automation on the back end to do background checks and kind of final diligence before we actually close. So the combination of the finance background and the technology background has really helped us build a company that allows us to source, underwrite, and service these at scale. And then we're supported by strong marketing, chief marketing officer, a 15-year veteran in the CFO and fund admin and compliance arena, and then additional individual helping us with capital finance strategy and kind of just general fundraising. Our current opportunity is a fund two, so we're raising $5 million cover, looking to potentially upsize to $10 million. But like I said, we had a first close earlier this year. We're taking from individuals smaller check sizes, so we're rolling up 25, 50, 100K checks and deploying capital as it comes in. We're targeting 20 to 25% IRRs, 2.8 times multiple on invested capital, and we're looking to distribute cash flow on a quarterly basis. Would be happy to answer any questions or talk to anybody offline after this.
I have a question. So what's the duration of your investment typically?
So we underwrite our income share agreements to about 6 to 7 years. And then there's always the long tail of equity, given that we're investing at such an early stage.
And you're really investing in the individual with the promise that they're going to pay back, or you're going to convert the debt into some kind of shares in the company. So I guess the question is, are these individuals with like engineering graduates? Even if they didn't go to Stanford or Harvard, what's their profile like?
Yeah, it's really kind of a mix, but a lot of finance professionals, a lot of I'd say about 40% engineers, so they do have some of that technical background. Finance, accounting, engineering, some sales, so some kind of more sales and marketing background. But it really does span kind of the gamut of background.
But people who are good credit risk, in other words, if they, if their company went under, they'd still find a job at Google or Facebook or somewhere and be able to pay you off.
Absolutely. That's the number one thing that we're looking for when we're underwriting is what is this person's future earning potential? That's what helps us size our investment. That's what helps us get conviction around the investment is, okay, we like to bet on this company. We like to bet on this individual. In a downside case, this company fails. What do we think this individual is going to go do? How employable are they? And what do we think their future income will be? That's kind of what helps us underwrite and hit our target returns.
And what's the capacity for your strategy?
So we think we can deploy $10 million in the next 18 months. We think that can then scale to 20 to 30 in the following 24 months. We think we can get it up to $40 million a year, really just using a lot of the platform that we've built so far. Obviously, this is new and we haven't kind of stress tested the scale of this thing, but we think as we continue to get more data, as we continue to automate, even kind of maybe decentralize some of our underwriting process, we think we can get it up north of 50, possibly even 100 million a year.
And you talked about non-Silicon Valley, non-New York deals. Are we talking like Boston, Philadelphia, Texas, any preferred geographic areas? I mean, there's obviously lots of growth cities that have some tech in them, great universities, et cetera. Maybe you want to discuss that?
Yeah, it's really all over the place. Let me see if I have. Yeah, so here's our Fund 1 summary. Again, this is only 12 investments, but we had a lot in California, just because I'm out speaking at California events. I live out in Santa Monica. But I think we've recently done a deal in Arizona, have a couple in Texas, some in Washington, I think some Ohio, Tennessee. So there is some kind of middle of the country, call them second or third tier hubs or growing cities that we're seeing some good opportunities in.
Fantastic, great. Well, I don't have anything else from the audience here, questions for Will? No. One more question.
You said there was a 10% personal income guarantee or after you make an investment. Is there where is the cap on that? Or
yeah, so the question is there's 10% gross income share. What is the cap? And so our cap is a 2x cap on the amount that's paid back on the income share agreement.
they borrow 40, they pay back 80.
Right. And there's an ability, if they pay it back quicker, to pay back 60 instead of 80, so 1.5.
Quicker being
5 years.
instead of
Under 5, instead of somewhere between 5 and 10. And it really just depends on, they can make discretionary payments or they make the required payments based on what their income level is.
Any other questions?
Very similar to the first loss seeding
Yeah, there you go.
in hedge funds.
It's analogous, yeah.
Yeah, very, very similar, obviously, than venture, but it's a strategy that's been used in a different form.
Yeah, I mean, that's first loss is you guarantee the first 10% loss by which time they're out, right? But what's different is that first loss typically is pretty liquid. His is less liquid, but what's interesting is that it's almost guaranteed to be paid back one way or the other. It's not going to be.
Yeah, one is actual money in, and the other one is money on the common.
Yeah. Yep.
It's pretty interesting. Is there an average age of the entrepreneurs you're investing in?
I'd have to look at that. But we have both later career entrepreneurs and we have early career entrepreneurs. We just funded our first individual coming out of college. And for his future earning potential, we looked at his degree, his school, and basically most schools give a range of, if you get this degree, this is kind of your range of expected salary. On the opposite side of the spectrum, we have 20-year executives that, they were able to put in 100K of their own money to begin with, but they really needed that support and kind of starting to plug into the VC world. And so they took our capital, and then we've helped make introductions to upstream investors. So yeah, age range is kind of all over the place.